Hi, you guys. I'm Phil Town from Rule One Investing, and today I want to talk to you about finding really inexpensive stocks, things that are on sale in this all-time high market. Can you do that? Look, the current market isn't looking its best right now. It's just manic, going up like a rocket, and we continue to see companies reaching their all-time highs, vastly higher than their intrinsic value. So looking for an inexpensive stock, something that's on sale, may sound nearly impossible, but it can be done. It might just take a little bit more digging than you're used to. So today, what I'm going to do is kind of show you how I go about it, going out to find a company in a really overpriced market so that I'm ready, I'm able, ideally, to be able to buy those companies now. And then, of course, if I can't find them on sale, I'll make a nice watch list and buy them when they go on sale. All right, so the first thing is we got to do a lot of research, right? That's the main thing. I do a lot of reading every day. I read a lot of stuff. So we're looking at each company to try to figure out if it's on sale. Now, the first thing I do to figure out if a company's on sale is I look at the basic numbers in the company, okay? So if I'm just scanning for companies. Now, what I want you guys to do is maybe narrow this down a little bit so you're focused on things that you really love, things you're passionate about, because it'll be much more fun for you and it'll probably be easier. But in general, if you're already fairly good at looking at companies and you've already broadened your circle of competence, then you can do what I do, which is essentially scan as fast as I can, looking for companies that I think may be worth looking deeper into. Now, the first thing that I look for when I'm looking at companies is I'm looking at return on invested capital. This is the single most important number you can look at, right next to the next number I'm going to tell you about. Return on invested capital or return on capital or return on assets. What it is, either any of these are fine, and some people think they're all the same. What these are is the earnings of the company divided by all of the capital in the company, including all of the money that they've borrowed and all of the equity in the company. And when a company has a really high return on invested capital, it means that it's got some kind of moat, especially if that return on invested capital is high for the last 2 decades. That tells you that's a big moat company and it's something to really like. Now, I'm going to combine that with another number. But first, let me tell you what a really high return on invested capital is. Really high means way up into double digits. It certainly starts at least 10%, but that's just okay. I like to see return on invested capital at 20%, 25, 30%. Some companies I'm finding right now out there have 40% return on invested capital. So they're not very many, but there's a few. So first we're going to look for something really high, ideally around 20% or better. All right, return on invested capital. Then the very next thing I look at, so this is just takes a split second. There it is, that number. Oh yeah, 20% goes back a long time, 20%, great, perfect. Now the next thing is debt. I want companies with no debt. That's ideal, all right? In that case, if they have no debt, the other number that I like to look at is return on equity, which is how they're doing with my money in the company. And that is identical to return on invested capital if there's no debt, right? Because return on invested capital is just the earnings divided by debt plus equity. So those two numbers are very closely linked. Now, when I see a company that has no debt, okay, well, some companies have a little debt and it's going to be a little debt's going to be okay. So less than a year of debt, I think of as no debt. That means that you look at the amount of debt, look at the amount of earnings. Is the debt lower than 1 year of earnings? Great. That's like having no debt. They're not even an issue. The most I want to see is 3 years of debt divided by earnings. So if you go, here's my debt, 900 million, my earnings are 300 million. That's 3 years of earnings to pay off the debt. I'll still look carefully at a company like that. If it gets more than that, unless it's some kind of finance company or a bank, I don't want to see it. It's just too scary for what can happen in a recession with companies with too much debt. So that's the second number, is debt. First number, return on invested capital. Then what I'm going to do is a very quick calculation of cash flow. Now, the quickest way you can do that, not the most sophisticated, but the quickest and easiest, is to just look at free cash flow. And that means you look at the line in the income statement, cash flow statement that says operating cash flow, and you subtract from that the capital expenditures of the company, which are in the next line on investing. So those two things, you guys can look it up, Google this stuff, and you can figure it out really quick, or just come and take our class and we'll teach you in about 3 days everything you need to know. So now we talked about return on invested capital, really high, debt, really low, and now we've got what's called free cash flow. Operating cash flow minus capital expenditure is called free cash flow. And that's the money the company can do anything it wants with. It can give it back to us as dividends. It can buy back its stock. It can buy other companies with it. It can do all kinds of things because it's already paid for all of its operations already before we got to that number. So what I want to see when it comes to free cash flow is I want to see a ratio between free cash flow and the price I'm paying for the company. And I'd love to see it at around 10%. Now, that's hard to find that. I'll even look carefully if it's at around 8%. In other words, it's basically the free cash flow, let's say it's $2 a share, divided by the cost of the stock, which is $20 a share. And if that's 10%, that looks pretty interesting to me. So a company that's got a really good price, which is free cash flow at 10% of what the price is, that would be amazing. No debt, very high return on invested capital. This would be a unicorn, right? We're almost never going to find this in this kind of a market. Now, the weird thing is they're all over the place when the market crashes. You'll be able to find these things everywhere when the market crashes. But boy, in this market, extremely hard. Now, basically, you know what to look for, okay? You're looking for great return on capital, very low debt, and a really good price, 10% free cash flow to the price of the stock. So how do you do this? Well, how do you dig through 11,000 stocks and find the few that might be good for this? Well, you got to use some kind of tools, right? So what you can do is go into our toolbox, which is awesome at rule1investing.com. And that has all the stuff you need to figure this out really quickly, and it helps you figure it out. Now, if you don't want to do that, you can go to other websites. You can Google websites. There are very few sites that provide you enough data for free. There are a couple of them out there, but usually they restrict data to about 5 years, and that's not enough. But let's assume you've got the data. It goes back 20 years, 30 years, and you can really get the picture. Now, you scroll through all these things, and you find a few that have these kind of categories, right? 10% return based on free cash flow to the price, really low debt, and a really high ROIC. Now what you got to do is look at it and say, can I understand this business? Is this something I even can get? Is this something I like to think about, or is this completely out of my ballpark? If it's out of your ballpark, don't even bother. Put it in the too hard box and go on. And what you're looking for is something you can understand that fits into these categories that we just looked at in terms of numbers. When you find it, then what you want to do is start digging. This is where the research really begins. But this is a real good shortcut. Now, this is what I do all the time, all day. It's what my analysts do. We dig through stuff to try to find these things that are cheap. Tough to do, you guys, but you can do it in this market. And if you practice doing this in a market as tough as this one, when this market finally crashes, oh, you're going to be so ready. So now I'd love to hear from you. Have you been able to find cheap stocks at all in this all-time high market? And by the way, if you found them, let me know what they are. I'd like to figure that out. And now leave a comment below with your answer, and I'll be sure to follow up with you. And thanks for watching. Now go play. Hey, if you enjoyed this video and feel it was valuable in teaching you more about finding, really inexpensive on sale